Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. South Korea's economy is growing faster than expected, but that strong momentum is bringing a new set of policy challenges. With inflation still running above target, the Bank of Korea has raised interest rates for the second straight month, signaling that strong growth may now be adding to price pressures. Now, at the same time, the government is heading in the opposite direction, preparing its biggest ever budget as it looks to turn stronger revenues into investment for future growth. So with monetary policy tightening while fiscal policy expands, can Korea keep growth on track without creating new risks for inflation, debt, and the financial markets? For answers to this, we are joined in the studio by Yang Jun, Professor of Economics at Catholic University of Korea. Very big welcome.
Happy to be here.
And also joining us online is Hwa-Kyun Kim, Professor of Banking and Finance at Texas A&M University's Mays Business School. Good to see you.
Pleasure to meet you.
So let's start a discussion with Professor Kim with today's rate hike, of course. So what do you think drove the BOK to raise its rates for the second straight month? And do you think it was the right decision?
I think it was a good decision. And the easy way to look at the interest rate from the standpoint of monetary policy is these two variables. So the one is basically the expected inflation or inflation, and the other is the growth potential and also the economic growth. So like you just briefly mentioned earlier, so the Korean economic forecast actually was higher than expected, or at least we have seen this, the chip exports and other things definitely just increasing the prospects for the Korean economic growth. Therefore, if the expected inflation is higher, then I think it's a good idea to increase the interest rate. And also if the growth potential is higher, it's good to just increase the interest rate. So in that regard, both, I think the expected inflation is somewhat higher than around 2% that normally the central banks actually target at. So it's around 2.5 to 2.8%, I think, depending on the definitions of the inflation. So it's higher. And also the growth potential or the forecast actually is higher. Therefore, it's probably a good move to increase the interest rates. Another angle to look at the interest rate is typically we just look at the real growth rate or the economic growth plus the expected inflation. That's going to give you a rough idea about how the interest rate of this the economy is. So if we just add up about this 3% or 3.5%, even the growth potential plus the about 2 point something percent of the inflation expectation, we actually have about 5 or 6%, roughly speaking, of the interest rate target in some sense. So we're actually still behind, the Korean interest rate, actually below that type of the interest rate. So in that regard, increasing the interest rate, I think, was a good move. I know that there were some different opinions in the market, but overall, I think this is a good move. Mm-hmm. And also from the standpoint of the exchange rates, I think the lowering the gap, the narrowing the gap between the U.S. rate and the Korean rate, I think it's a good idea. So overall, I think it was the right move.
Mm-hmm. So with the BOK now seeing much stronger growth, then how much did that factor into today's decision compared with inflation concerns?
I think it was definitely one of the key anchors. I think it was important decision-making points. And I think given that inflation expectation is still higher than 2%, and also the housing price still a bit higher, and also the oil price and other import price is higher, I think the BOK definitely wanted to raise the interest rate even before the Governor Shin, I think. But I think because of the many other issues, especially somewhat lower expected growth, at least I think about a year ago or a year and a half ago, that even if the BOK wanted to raise the rate at that time, they were actually hesitant to raise the rate. Now the economic forecast is higher, actual growth is just supporting that. And for the time being, it's going to be like this. Therefore, I think the BOK was a bit more confident about raising the interest rate to fight against the inflation and potentially other issues such as exchange rates and something else. So I think overall, I think this was actually a very important point about this raising interest rate, the economic growth. And at the same time, now the exchange rate, I think, is finally just going back to its mean which is about like 250 or 201 per dollar. But still, I think it's way above like that. So the BOK still probably tries to also handle that with this interest rate increase as well.
So it really gave more room for the BOK to focus on inflation. Now, adding to this, Professor Yang, Moody's is even more upbeat. It forecasts 3.5% growth this year. What do you think is behind this such a sharp turnaround?
Okay, well, it's basically exports of semiconductors. Moody's is slightly higher than others at 3.5%, but other recent estimates are not really that far behind. KDI just came out with their estimates last week. It was 3.2. Bank of Korea came up with 3.3 today. So 3.5 is slightly optimistic. It's not completely out of the range of possibilities. In fact, the way that the estimates for the growth rate has shot up in the last 6 months, I would not be completely surprised if it's even higher than 3.5%. But having said that, there's still a lot of uncertainty involved. If we look at the Bank of Korea report today, I was a bit surprised because they have something that they don't usually have, which is they listed some possible positive and negative shocks that can affect the growth estimate. And if there's a negative shock to the semiconductor sector or the Middle East gas prices, each may bring down the growth by 0.1 percentage point. On the other hand, if things are brighter in these fronts than expected, if the semiconductor boom accelerates, or if the Middle East Iran war ends early, then the growth estimate is may rise by 0.2 percentage points for semiconductor boom, 0.1 percentage point for Middle East gas price falling. So the best case scenario by the Bank of Korea estimates is actually 3.6%. On the other hand, it could go as low as 3.1%. So, and if you compare the details between the KDI estimates and the Bank of Korea estimates, they're actually, in some ways, some different for investment and for exports. So I think that just gives you an idea that while Korea is expected to grow very well this year, there is still perhaps a lot more uncertainty than usual years. So even though there's only about 4 months left in the calendar year, there's still a lot more uncertainty compared to other years.
Right, so that's why they were able to provide those kinds of variables, of course. Now, as you've mentioned, Professor Yang, chips are still a major driver. Then how much of that strength do you think is spreading to the rest of the economy? And also, is growth still too dependent on semiconductors?
Well, I'm not sure if the dependence is the right word for it, but it's definitely being led by semiconductors. If you look at the Bank of Korea report today, then they adjusted the consumption numbers from 2.0 in the last estimate to 2.1. So there's only a very slight increase in the expectation of growth rate for consumption. Construction, the same thing. It actually fell in the Bank of Korea estimates from 0.6% expected growth in the last estimate to 0.2% growth in the current estimate. KDI is sort of similar. They did not, when they revised the numbers and published the revised numbers last week, there were just slight increase in consumption and no changes in construction. So all the action is taking place in investment and exports. And from the Bank of Korea report, the facilities investment, the business investment growth rate was revised from 4.4 to 6.8%. Exports, the previous estimate was 4.9% growth for this year. It was revised to 9.7%. So basically, it's telling you that all the action is taking place with the semiconductors. Now, next year's growth, both do expect some effect to go outside the semiconductors, but the problem is, will it take place again? That is uncertain for now. But for now, this year, all the growth is expected in the semiconductors industry.
So the key would be whether this can spread beyond the semiconductor industry as well. Now, we are seeing 2 straight hikes. Then what about the next? Professor Kim, where do you think the rates would go from here? Do you think another rate hike is possible this year, or is it time for the BOK to wait and see?
Both are possible, but I would say if the economic growth prospectus continues, probably led by the chip exports and also other parts of the economy actually recovering better, I think the BOK is probably going to raise one more time. But if you look at the Fed rate target, which is around like 3.5 to 3.75%, so I think we are getting closer. So I think the Korean I would say the rate is likely to be stay around like 3.25 to 3.5-ish. So I think for the time being, as long as the growth actually potential not completely just going the opposite direction in the next 6 months or a year, I would say one more time. But probably the next time they will pause one time. And then if the economic growth actually after the first half is still pretty strong and persistent, I think in the next half, I think the half of the early 2027 at least, we will see one more hike or two, probably just evening out with the U.S. interest rates. And I think that's probably the right call given all the movements of the interest rates, also exchange rates and expected inflation, etc. So, but that's my guess.
So markets will have to watch closely on the next movements on that. Now, shifting gears, Professor Yang, the government is also moving to the other direction when it comes to the budget, a record budget of more than 800 trillion won. But we've been saying that the growth is already quite strong, though uncertain. Do you think this level of expansion is really necessary?
No. So let me explain why. We are expecting 3.3% growth this year. The potential growth rate for Korea is estimated somewhere between 1.5 to 1.8% for this year. So the actual growth is double the actual expected growth rate. And usually when you have the actual growth rate that high above the potential, twice as high as the potential, that usually means overheating. Now, there's some special technical issues involved here. The growth is mostly taking place in the semiconductor sector, so other sectors are still in a more or less a slowdown. A lot of the growth is taking place, and this is a very technical issue, but rather than increase in volume of semiconductors produced, it's actually due to increase in prices of semiconductors. But still, this year's government expenditure was the largest on record. Next, and they're planning to increase even more, as you said, 800 trillion won next year. And a lot of that is actually concentrated in the AI sector. The government's justification is that they want to strike while the iron is hot, so they're going to keep on investing in the AI and semiconductor sectors. I think they have enough money there already. So they're really in danger of overheating that sector. Now, I have no objection to R&D expenditure in that sector. China is catching up, US is catching up as well. Also, some infrastructure may be needed, but do we really need some direct subsidies for some of these companies when there's more than enough money going around in that sector? I don't think so. If they are going to spend the money, maybe they should reallocate it into some of the sectors that are not doing well, assist structural adjustment there. And also, we're not going to have years like this every year where we have so much tax revenues. So we should take more care about government deficit and increasing the debt.
Right. As Professor Yang has mentioned, a bigger budget also raises financing concerns as well. Then, Professor Kim, how much of a risk is greater government borrowing to bond yields and market rates?
I think that's one of the probably underappreciated risk because, we normally use this fiscal expansions, especially if the economy is in hard, the situations and things like that. So sometimes people view it as most sort of like a rescue team or something. But as Professor Yang mentioned, I think at this stage, economy is already doing really well, and the private sector has enough liquidity, I think, to do R&Ds and things like that. So I'm not a big fan of talking about the crowding out effect of like this, government sector sort of like eating out the private sector. But in this case, it's possible, I think, because other than semiconductor areas, I think the other areas are still like, not completely just recovered. So I think it's in the middle of doing this. So if we have to help a little bit, given the budget, probably we can help the other sectors a little more in terms of like, the related areas and also somewhat like, less related areas. But I think, just increasing these kind of things is going to just only increasing further this risk, especially related to this financing part, because if you actually borrow more, then what happens is going to be the price of the borrowing is going to be costlier, meaning the interest rate is going to be even higher. So I think now the Fed, the BOK is increasing the interest rate in the short term. And now if the fiscal side is going to borrow more, and therefore this is going to also increase the interest rate for both short-term and long-term, I think this is going to increase the overall interest rate. So that means the borrowing cost for other areas like the private sectors, especially the housing and many other sectors, will have issues, especially if they already have a lot of debt, which I think is probably the case. So one of the risk I think here is the coordination risk. I'm not sure how intimately the BOK and then the Treasury actually are talking in this point. But given that the BOK is doing the right move in terms of fixing probably the inflation part and also the cooling down slightly in terms of the exchange rate risk and things like that, I think the fiscal side of the expansion probably, if it can be curbed a little bit, I think that's probably the better scenario.
So too much borrowing could be really burdensome in many areas, especially, aging and other spending pressures are growing in the country. Then, Professor Yang, how much room does Korea have to possibly keep expanding its budget?
Not much. This year was an extraordinary year in terms of tax revenue. They're expecting this to continue next year, but there's no guarantee that it will last every year from now on. And if you keep on expanding the expenditures, especially in the non-discriminatory, non-discretionary areas, then you're stuck with this large expenditure, but your tax revenues may fall. And then there's sort of the international aspect. Ever since President Trump passed his budget bill for the U.S. last year, there has been a lot of attention being paid to government deficits and debt, not only in the United States, but in most advanced countries. Now, in Korea, our debt load is perhaps not as bad as some of the other advanced countries, but it's rising, and because of these demographic factors, because of the falling productivity, everyone knows that it's going to increase. So we have an extraordinarily good year this year for tax revenues, but it appears like we're not really taking care of reducing the deficit or reducing the debt. So if we're not going to do it when we have a really fortunate year this year, when are we going to do it? And that could, I think, really affect the international borrowing rates for Korea, not only for the government, but perhaps Korean firms as well.
So the repercussions, it really goes beyond just the budget itself. So with monetary policy tightening, while fiscal policy expands, Professor Kim, how should the two work together from here on?
That's always a million-dollar question. It's a hard question. So I think monetary policy definitely should keep doing what it's built to do. So to manage the inflation cycle and then lead against the speculative excess areas in like housing or some other, the stuff, and also the macro prudential tools in terms of looking at the loan to value, debt service ratio limits and things like that. So I think BOK is going into the right direction. So I think keep just doing what they're doing, I think would make things probably just in good mood, and also to make the investors happier and then people happy, I think. Of course, they have to keep watching because, there's always nowadays, the political uncertainties just around the world is just very big. So I think, always just keen on that, I think is important. Fiscal policy, meanwhile, needs to be far more, I would say, selective than a just blunt kind of the broad-based kind of stimulus, especially if the fiscal side is going to be expanding like this. And I think this one can actually also generate additional inflation. So the physical sort of the story of the inflation is non-trivial. So if you just keep borrowing and if you just keep spending, that's going to basically just to make the money just everywhere, the easy money, basically. That means inflation is also likely. So at least in terms of policy coordination for the time being, if the fiscal side is going to be a little more, I would say, just prudential about that, I think that would be nice, especially given that our projection for this fiscal, the expenditure is going to increase. I think this would be a good idea to at least to coordinate well with the BOK, and also to think about just paying back some of the debt to lower the debt to GDP ratio and things like that. So I think overall that's probably what's remaining.
Right, so we'll have to find the right balance between supporting growth and keeping inflation and debt risks in check moving forward. Thank you so much for your insights tonight, Professor Kim.
Always a pleasure.
We'll have to wrap up here. Thank you so much, Professor Yang, as well.
Thank you.
And that'll be all from us on Within the Frame tonight. Be sure to tune in again next time as we continue to explore the stories that matter. Until then, stay informed and engaged.